Group 4 Market Update. Jacob Hales, Chase Chatelain, Nate Berger, and Austin McBride.
8 IPOs were completed during the week, raising an average of $472 million. The largest IPO coming from VC Properties, an asset-focused REIT. This week follows January, where we saw a record high for IPOs in any January in history and the highest individual months since September 2014. During the week, there were a total of 185 M&A deals completed with a total deal size of over $14 billion. The most deals by count came from the B2B industry, accounting for 47% of all deals. However, by total amount spent on deals, information technology had the largest amount with roughly $3.78 billion. The top 5 M&A deals completed during the week had an average deal size of $1.12 billion. The largest deal was Cisco Systems' $1.9 billion acquisition of BroadSoft. Hubble's acquisition of Aclara Technologies represents another billion-dollar acquisition completed during the week. In notable M&A news, Broadcom has raised their offer to acquire their rival chip maker Qualcomm to $121 billion. The offer is for $82 per share, $60 in cash, and $22 in Broadcom shares. This deal would be the largest tech deal in history and is contingent on Qualcomm to complete an acquisition of NXP Semiconductor for $38 billion. The deal would create an estimated $3 billion worth of synergies. Some roadblocks in the deal include Qualcomm's leadership's disapproval of the deal and possible antitrust problems. In other M&A news, Comcast is considering to top Disney's $52 billion offer for 21st Century Fox. AT&T is exploring a possible sale of their data center business that could warrant a price of over $1 billion. Dell and VMware are exploring a possible merger, and Dell is set to decide to either file for an IPO or merge with VMware to boost their profitability and help improve liquidity problems. Nektar Therapeutics is exploring options, including a potential sale for $15 billion. The company has received interest from large drug makers and saw their stock price increase 12% after the news broke. In M&A deals announced this week, Kroger has announced that they will be selling their convenience store business for $2.15 billion to the UK gas store operator EG Group. The deal is set to close by Q1 of 2018 and will include 784 stores across 18 states. EG will benefit off of Kroger's business that generated $4 billion in revenue during 2017. Kroger plans to use the proceeds to buy back shares and lower their debt. Advisors on the deal included Goldman Sachs for Kroger's and Morgan Stanley, Bank of America Merrill Lynch, and Barclays for EG. Other M&A announcements include Motorola is set to buy Avigilon, the security camera maker, for $978 million, equating to an estimated $33 per share. Mitsui & Co. won a bidding war to acquire AWE for $470 million. The offer represents a 74% premium to AWE shares. Terraform has made a bid for $1.2 billion to acquire Zeta Yield for their solar and wind power utility company. Mid-Tates Petroleum offered to merge with their rival Sandridge Energy in an all-stock deal. Sandridge shareholders would receive 60% of the combined equity.
So we'll just take a moment to review some of the general market and economic conditions in the United States right now. Wages have increased throughout the month of January with a 2.9% increase from a year earlier. This is the most significant gain since June of 2009 and may have been a reason for the volatility in stock markets we have seen this week because it fed fears that inflation is rising. There was a mild trade skirmish with China after the US implemented higher taxes on solar panel imports. Economists are generally optimistic about the economy in general and forecast that the Federal Reserve will have 3 or even potentially 4 U.S. interest rate hikes throughout 2018 under new Federal Reserve Chairman Jerome Powell. They also projected the unemployment rate would fall below 4% by mid-year from 4.1% in January. A panel of economists interviewed by the Wall Street Journal has cited that they have a 14% chance of a recession, citing good salary and wage growth. They believe that there will be upward pressure on inflation because of continued growth and low unemployment, and the stronger inflation could lead the Fed to have more rate increases throughout the year. This week, we have seen some unprecedented market volatility in the U.S. stock markets. Throughout 2017, global markets slowly and steadily marched upward, with the Dow Jones recording record gains and new highs. but over the past week, market gyrations have frightened some investors and caught the attention of the financial public, with the Dow dropping over 1,600 points on Monday. Nowhere was the market's change in sentiment more glaring than in Wall Street's fear gauge, wrote one Wall Street journalist. The volatility index, or fear gauge of Wall Street, known as the VIX, spiked dramatically after the late day trading on Monday afternoon. Many exchange-traded funds additionally suffered losses as a result of the plunge in the stock market. However, some forecasters are unshaken by this volatility because of the belief that many U.S. stocks were overvalued before the sudden decline. Some have blamed risk parity funds as well as automated quantitative trading strategies for the large sell-off, but the exact cause of the volatility remains unclear. Additionally, there is a 2-year budget deal, which congressional leaders reportedly approved Wednesday. If it is approved by a Republican-controlled Congress, the measure will increase both military and non-defense spending, as well as raising federal spending by around $300 billion over 2 years and suspending the debt limit through March 1st, 2019. Few major regulations have been announced this week, but we may expect looking forward that the Securities and Exchange Commission and the U.S. Commodity Futures Trading Commission will potentially pass regulations affecting Bitcoin and other cryptocurrencies, as well as holding broker-dealers to a fiduciary duty, which would raise their level of responsibility towards clients. The Trump administration has publicly expressed its intentions to ease regulatory restrictions in the securities market, and 2018 looks to be the year that legislative actions may begin to have a more pronounced effect on the securities market. This Wednesday, President Donald Trump met with the top U.S. derivatives regulator in the Oval Office, Commodity Futures Trading Commission Chairman J. Christopher Giancarlo, and a White House spokesperson said the meeting was focused on developing the best regulatory environment in the world. As far as tax reform goes, no major new tax legislation has been passed that affects the financial markets, but we are still awaiting the full repercussions of the corporate tax cut that was passed on January 1st of 2018.
As markets were hitting record highs, stocks went in free fall on Monday, February 5th, as the Dow was down more than 1,600 points, by the end of the day declining by 4.6%, the largest drop in history. The Dow was obviously not alone on this historic Monday. Monday also marked a plunge for the S&P 500, closing down 4.1%, the worst decline since 2011. Although the S&P did rally back, it is still down from the drop that occurred Monday. The Nasdaq dropped 3.8%. Despite the bounce back, the steep losses from the Friday and Monday's trading sessions have erased the U.S. market's gains from the start of the year. The Canadian TSX also saw a large drop on Monday, February 5th, as losses in energy, financial, and consumer sectors brought shares lower. At a close on Monday, it declined by 1.78%. European markets were also largely affected. The FTSE 100 dropped 1.5%, its lowest close since December 7th, and its worst week since April last year. The weakness in the Canadian index and European index came as traders took a cue from the US. As stocks fell, so did some of the world's major commodities. Over this week, gold fell by 1.95% and silver also fell by 5.37%. Crude oil prices also dropped this week. Although they are not directly correlated to the stock drops, oil prices dropped as U.S. oil barrel stockpiles climbed. Crude oil prices dropped more than 8%. Over the week, there was only one main global currency that grew against the dollar, and that was the Japanese yen. Over the week, the Canadian dollar fell against the US dollar, along with the peso, the Swiss franc, pound, and the euro.
Blackstone is set to buy a 55% interest of Thomson Reuters financial and risk business for $17 billion, marking the fund's largest buyout since the financial crisis. The investment reportedly comprised of $4 billion in cash and $13 billion in new debt. This deal plays to the trend of the importance of software and financial data, as Thomson Reuters provides financial data and analysis for banks, investors, and other financial professionals. Software was the largest growing sector last year in private equity, and technology deals have grown for 8 consecutive years. Last year, total buyout activity reached a total of 3,415 deals, summing up to $517.5 billion, becoming the largest year since 2007. After a strong January, deal activity is expected to outdo last year. This week it has been revealed that Airbnb former CFO Lawrence Tosi had quietly built an internal hedge fund within the company's finance department. With training at his former job with Blackstone and using capital from the company's balance sheet, this side project is estimated to have made the company an extra $5 million a month for Airbnb. Tosi and the co-founder clashed on the topic of whether the company should IPO or not. Tosi strongly advocated to make the company public, and this eventually forced him to walk away from the company because the co-founder argued and wanted to stay private. Revenue for Airbnb last year exceeded expectations by about $120 million. As much as $60 million of that revenue is most likely to have come from this hedge fund. It is unusual for such a young company to have enough cash to invest so aggressively and to enjoy such nice returns. So if and when Airbnb does go public, that extra cash flow generated by this secondary business would certainly make a comfortable cushion. Also this week we have found a scam that the SEC has been investigating involving Nicholas Genovese, a hedge fund manager of Willow Creek Investments. It was made public that he has raised over $5.6 million from at least 6 different investors by misrepresenting all of his credentials. The situation gets even stickier because he mingled these funds with his personal brokerage account that sustained over $8 million of losses over the past 3 years. This is an ongoing investigation, but it is anticipated that this hedge fund manager will face serious penalties soon.
Thank you so much for listening.